Hello, and welcome to Portfolio Matters Weekly Update, week 49. And yet again, it's been an interesting and volatile week in the markets. It seems we're not going to get a Christmas break this year. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what have we got this week?
Well, I'm afraid we've got a really packed week this week. We've got a lot of data to get through, and we'll try and push through this quite quickly. So the news this week was that, well, frankly, there wasn't very much. We just had new coronavirus restrictions in the UK to try and control the spread of Omicron. And around the world, we have had bouts of volatility as the markets digest the latest news about Omicron and fluctuate between pessimism and optimism. Okay, so this week's economic data. Now, last Friday, after the recording of the weekly, we had a load of data from the US. So the big number was US non-farm payrolls, which came in at very disappointing. Only 210,000 jobs created in November, well down on October and below expectations. Now, the non-farm payrolls comes from an employer survey, and frankly, that number seems at odds with all the other data on the US market, US employment market, and we will show you lots of other charts which suggest that the US employment market remains strong. So in particular, household surveys are directly contradict the weakness seen in the non-farm payrolls data. So perhaps that is just a bad data point. The US unemployment rate, for instance, came in at 4.2%. Well down on October and well below expectations. And that suggests the job market is strong. Average hourly earnings were 4.8% in November, the same as October, and slightly below consensus. So that's reassuring for inflation. ISM non-manufacturing PMIs were great. 74.6 in November, well up on October, and massively beating expectations. So services in the US look strong. Non-manufacturing new orders were 69.7, unchanged from October and ahead of expectations. Employment index was 56.5, well up on October and above consensus expectations. So again, this contradicts the non-farm payrolls. Now, we had some data for December. So the US IBD/TIP economic optimism index hit 48.4, which is well up on November and above expectations. Again, painting the picture of a strong US economy. Now, US wholesale inventories ticked up to 2.3% in October, up on September and above expectations. Now, this is a data point to watch because we know that there's a lot of inventory stuck in the supply chain. And as supply chain bottlenecks ease, a lot of inventory is going to come out, and then you may well have an inventory glut, which will depress economic activity. So we'll be watching this going forwards. Moving to the UK. In the UK in November, construction PMIs came in strong at 55.5, up from October and above consensus expectations. That was good. Now, the good news was that new car sales were actually up year on year in November, up 1.7%, which is a massive change from October when they were down 25% year on year. And that massively beat expectations. So that all suggests that the enormous supply chain bottlenecks you're seeing in the car industry due to the global chip shortage are starting to ease. Okay, in the EU, the economic sentiment index for December came in at 26.8, which was well up on November and beat expectations. In Germany, the economic sentiment index was strong, 29.9, but down on November, but ahead of expectations. But the current conditions index dropped massively in December for Germany, down to minus 7.4, an enormous drop on November, and a big miss of expectations. And when we show you that chart, that is worrying. So German industry is concerned about presumably the energy crisis and the return of Omicron. In China, exports grew 22% year on year in November, which was down on October, but still a very strong number and beat expectations. Imports grew very strongly, up 32% year on year in November, well ahead of October and well ahead of expectations. Inflation ticked up to 2.3% in November, big up on October, but missing expectations. And we also had some quarterly numbers. European GDP growth quarter on quarter was 2.2%. Year on year, it was 3.9% in Q3, which was slightly ahead of expectations. In the US non-farm productivity fell substantially in Q3, down 5.2%, presumably because you're having an increase in the number of workers and the wages, and output has been disrupted by supply chain. I'm not sure, but anyway, that is not a very good number. And unit labor costs grew 9.6% year on year. So that is wage inflation and evidence of a wage price spiral. Richard, do you want to do the charts?
Thanks, Keith. So it's US non-farm payrolls, whereas Keith said the number of jobs added is the lowest it's been since the beginning of the year, and is indicating that the job market is not as strong as it was. Although the unemployment rate is very low, clearly as the unemployment rate gets to wherever it's going to level off at its minimum, then the non-farm payrolls is also going to level off, which is probably what's happening. Over a longer timescale shows a huge boom in early 2020 in the unemployment rate, and then it's coming back down, and it's now really back down to its pre-average, relatively recent pre-COVID levels. And of course, we also have the issue of the labour participation rate having dropped substantially in the US over the course of the pandemic, tightening the employment market. And the US average hourly earnings change. This is a year-on-year change, Keith, I believe.
Yes.
And so it has, I think, it remains to be seen whether we enter into a wage price spiral. But as Keith was saying earlier, all the indications are that it is likely, or certainly significantly possible, that could happen. And the labour force participation rate, which is around about 2%, 1.5% to 2% lower than it was pre-pandemic, and isn't showing any signs of reversing back to its normal level.
Well, actually, Richard, I would say in the last month, it's ticked up. So you would expect as wages rise and some of the COVID fear dissipates, that people might start coming back into the labour market. You remember a few weeks ago, we showed a table of the reasons people had left the labour force. And actually, a lot of it was fears over COVID. And as those dissipate, perhaps people will come back in, which would be great, increase the labour force.
Yeah, possibly so, Keith. It's difficult, isn't it? At the moment, it's at the level of the noise of the charts. Yeah. And the question is it going to move outside that noise level?
Yeah.
US ISM non-manufacturing PMI, which is extraordinarily high, and US ISM non-manufacturing prices, which are also at a very high level and indicate continuing healthy economic activity and unhealthy price rises. And the ISM non-manufacturing new orders is also indicating a very strong US economy.
Mm.
And the non-manufacturing employment is looking healthy.
Yeah, and that's in direct contradiction to the non-farm payrolls.
Yes. And the economic optimism, it's pretty volatile, this, isn't it? It has a volatility of, plus or minus 5 is really par for the course, but it is at the bottom end of its range at the moment, but having spiked back up recently. So it's not indicating there's any problem. It is indicating potentially that the economic optimism is rising again in the US.
Yes, and we've had positive economic surprises. So,
yes. Wholesale inventories, as Keith pointed out, have gone up substantially and quickly. And the inventory level has basically changed from pre-COVID, pre-pandemic. And there's a sort of substantive change in the inventory level bar chart here, which suggests that companies are maintaining higher levels of inventory. And the logic behind that would be that if there's a supply problem, you want to make sure you've got more than just-in-time ordering. And I suspect part of this is we're moving away from just-in-time inventories to what would have been the more historically normal form of inventory, where you make sure you've got 3 or 4 weeks of inventory on site and available to yourself. New jobless claims is just showing continual decline, and the trend is still intact. And the continuing jobless claims, likewise, it's still showing continual decline. I mean, you could say, is the trend changing? I would say it's a little bit early to say at the moment, but it's sort of plateaued over the last few weeks, roughly. But the overall trend is a continuing downtrend in continuing jobless claims. UK construction PMI is healthy and has recovered to some good pre-COVID levels. And the EU economic sentiment indicator, I find this chart very hard to interpret, Keith, because it is very volatile, isn't it?
It is. I mean, I think the reassuring fact is that it seems to have stabilized at levels which are consistent with, actually a decent level in the last cycle, well above 2019 levels.
Yes.
Germany is the same, but the current conditions index in Germany is turning back down in a worrying fashion. Yeah,
and very steeply as well. The China year-on-year exports, the year-on-year export growth is very healthy from the point of the Chinese economy. And the Chinese year-on-year import growth is very significant, which obviously goes hand in hand with the export growth.
Well, it's very good for the rest of the world.
Yeah.
Okay, on to Inflation Watch. And we didn't have any new data this week. So we are awaiting CPI numbers for the UK and the US for November. But everywhere, inflation is continuing to run hot. And so the City Inflation Surprise Index hit a new high in November, which is not reassuring for the expectations for UK and US numbers. And just a reminder that despite inflation running hot, US monetary policy is extraordinarily loose. So the Taylor rule calculates where monetary policy should be to meet the bank's 2% target. And that is the white line. The blue line is where the Fed's fund rate actually is. And the gap between the two is at a record. So essentially, the Fed is just being extraordinarily irresponsible in its loose monetary policy. And frankly, what it's hoping to achieve with all the money printing when you've got a very tight labor market is beyond me. And as a result of all that, the US money supply has grown much faster than the money supply in other countries. And when we look at the table of inflation, it is no surprise that US inflation is running much hotter than in other countries. They've printed more money. And this is a comparison of the monetary expansion in the US during the current COVID pandemic and after the great financial crisis. And you'll see it's just of a completely different scale. We have overcooked this. And the yellow line here is other countries' net liquidity injections. The red line is the US, i.e. the US have just kept on when other countries have been more prudent. And wages are rising in the US, and that is obviously, if you have wages rising, then people have more money, so they have more spending power, so that's higher demand. That means prices are going to rise unless you also get an increase in productivity. Jobless claims are low and falling, as we've covered. Job vacancies as measured by the JOLT. Now, this is data to October, but that shows job vacancies at a record high. And so wage growth is very strong because there are a lot more job openings than there are people to fill them. But I mean, one good thing is that wage growth is higher for poor young workers than it is for white collar, highly paid workers. So this shows the difference between the white line is the wage growth of the lowest quartile wage earners, and the blue line is the highest quartile. And you'll see there's a decent gap. That's good for inequality. And the white line here is wage growth for 16 to 24-year-olds. And that's actually amazing. 10% for essentially, you're mainly looking at service staff in restaurants, etc. There's people that started their careers, and the blue line is old people, 55 plus.
So global container shipping rates are, these graphs show that they're falling, and they are either falling or level. So New York to Rotterdam and Rotterdam to New York, universe, pretty much the same, pretty much sort of plateauing, and other rates are falling slightly, but they're still much, much higher than they were pre-COVID, and they are 2 to 3 times higher than pre-COVID often. So that's indicative that there is still a shortage of shipping. And I have heard that although Biden has tried to do something about the backlog of container ships waiting to offload at US ports, what he's actually done is he's told them to anchor 50 miles offshore so they can't be seen. And it hasn't actually changed the backlog of ships waiting to offload. It's just made it less visible.
Fantastic. That's a great political solution.
So ammonia prices. Keith has an interesting tale about ammonia prices, but ammonia is basically produced, I believe, as part of the process of producing fertilizer out of natural gas. And so ammonia is used in fertilizer. It's also used in urea, but Keith was telling me the other day.
Yes.
Keith.
Global supply chains are now very interlinked and complex. And we know that when natural gas prices are very high, that fertilizer prices, which are essentially you make fertilizers, that's ammonium nitrate, using the Haber-Bosch process and vast amounts of natural gas. Now, we've covered in previous weeks how the spike in natural gas prices has meant fertilizer factories have had to close because it's just uneconomic. Now, a side effect from that is that urea is a byproduct of fertilizer. And it turns out urea is used in diesel engines in order to suppress NOx production. So this is how a emissions control system in a diesel engine works. Essentially, here you inject DEF, which is actually turns out to be urea plus water. Now, most of you will have come across DEF because it's AdBlue, which you see for sale in service stations. And AdBlue is mainly exported from China, and China has stopped exporting it, presumably because they've cut down on the production. But the problem is that a lot of modern diesel engines will stop working if you have no DEF. And so, unless you sort out the supply chain, a lot of the global transportation industry will suddenly grind to a halt. Now, I don't think this is going to happen. We should find a way of fixing this because this would be a huge problem, but it just shows how interlinked the global supply chain is.
I guess as long as it doesn't have some sort of sensor that tells it it's being tricked, you could probably just put water into it, couldn't you? But what it won't do is run when it's empty. But as Keith says, the supply chains are so interlinked. These things are so complex. Nobody really understands how they work. And this is another example of it's the impossibility of understanding the global supply chain and the knock-on effects of things going wrong with it.
Yes, that's a good solution, Richard. You heard it here first.
Yes. Let's start bottling it, Keith. Water. So this is a graph of German one-year prices, which shows that they are looking very uncomfortably high. The power prices, and they're still they spiked up, they've dropped back down, and they've spiked back up. So there's clearly an issue here. And I noticed, I think it was yesterday's FT, that the new shadow business secretary in the UK, who has replaced Ed Miliband, who was the shadow business secretary. And why anybody thought Ed Miliband could do that job, I don't know. But the new shadow business secretary is saying the UK needs to support energy-intensive industries. They are coming under huge financial pressure, and if we don't support them, we will lose them. And he's absolutely right. And clearly, it's not just a UK problem, but it is a big problem.
Yeah. No, this chart is really worrying because it's 1 year ahead. This is not spot. This is the price you would pay to lock in power over in 1 year's time. And you see it's quadrupled over the course of a year. France is the same, and it's still rising. Energy-intensive industries throughout Europe are facing extraordinary cost pressures.
The EU carbon prices shooting for the moon. But yesterday, I noticed that my KFA carbon ETF took something like a 7% drop, I think it was. It was a very substantial drop. But I couldn't actually find out why. But clearly, what I referred to, I think in previous podcasts, is that at some point, regulators will have to say, well, we can't keep adding to the pain of increasing energy costs, the increasing energy costs of doing the job itself. Yeah. So there will have to be some safety valve for carbon future prices at some point.
Yeah, when we covered this in some depth in a previous weekly. I can't remember which one, sadly, but if anyone's interested, go back through the back catalogue and have a dig. Now, last week, we covered this chart showing the increase in bank deposits in the US. And we were puzzled by the fact this chart shows that the total deposits held have basically gone up almost fourfold. But we know from other data that households' checkable deposits have only increased by about 30%. Well, thank you to Albert S., a viewer who has explained this to us. So the 3.6 trillion is households plus non-profit organizations. Households now hold 1.6 trillion, which is a 30% increase on 2 years ago. So the bottom line is households do have 30% more money than they had 2 years ago. So, money to spend, no wonder we've got inflation. In the EU, inflation is running at 4.9%. So the EU has cut back its pandemic emergency purchase plan to only 60 billion euros a month. God, prudence.
And as we've discussed previously, they can't cut it back. We don't believe they can cut it back to zero because there would be no one to buy the peripheral European bonds.
Yes, and actually, on that note, Richard, we will be showing Greek 10-year yields later, and they ticked up quite fast this week. So cutting back on the PEP will have consequences for the Eurozone. Now, regular viewers will know that we have covered how central banks are trapped because there's an enormous amount of debt, and if they raise interest rates too high, then they increase interest costs. But running inflation hot, it also suits everyone because you erode the value of the debt. And what this chart shows is the policy is working. So inflation has cut the US federal government's debt to GDP ratio from 135% a year ago to 125% now. So their policy of, talking about how inflation is transitory and not doing anything about it is a success. They are gradually eroding the real value of the debt. Expect more of the same, I would say.
And it's what every over-indebted economy has to do.
Now, regular viewers of the weekly will notice that we haven't had any charts from Nordea recently. And that is because Andreas Stino Larsen, the last few charts we had from him were about how the booster jabs in Israel did not seem to have stopped a resurgence of cases in Israel. And remember, Israel has the best data. Anyway, that caused him to be fired. So because some Norwegian MP complained that he was spreading conspiracy theories, and he has disappeared. But Nordea have now appointed somebody else. So we once again have charts from Nordea, and this is their model of US inflation, and it suggests it's going to get higher in the US.
I'd say, Keith, there's nothing like shooting the messenger for solving a problem, is there?
Absolutely. There are some things you're just not allowed to say these days.
Yeah.
Okay, so a bit on the US jobs report, which was very disappointing. So we only had 210,000 jobs created, according to the survey, but that's directly contradicted by the fall in the unemployment rate. And there seems to be a big difference between surveys of employers, which were disappointing, and employees, which were optimistic. But again, government continues to lose jobs. Now, remember that there are various vaccine mandates in the US, and people have been leaving the government rather than complying with them. But one positive aspect was that 594,000 people rejoined the labor market in November, according to household surveys, and hence the participation rate rose. So this is the participation rate, and that is a nice looking chart. Okay, so a brief piece on market liquidity. So this is the VIX, which has jumped up as we've had a sell-off over the last couple of weeks. This is the open interest in various US oil gasoline futures over the course of the last few weeks. And you've seen there's been a huge drop-off in the size of open positions, which has been behind the fall in the oil price. And this reiterates the point. So what seems to have been happening in markets is that in the last few years, we have had a transition towards high-frequency trading, providing most of the liquidity. And what happens is when high-frequency traders see an imbalance in the market, so there are more sales than buys, they simply step back. And so you have lower liquidity, more volatility, and in particular in oil markets, we look at the graph of the oil price over the last couple of weeks, which we will show you in a bit. You'll see there was a 25% drop in 2 weeks, and then it's bounced back. And that bounce back indicates it fell below fair value on liquidity, lack of liquidity. So bear in mind that the lack of traditional market makers willing to step in when there's an order imbalance means that volatility is exacerbated. So don't get into crowded trades. Crowded trades like when hedge funds were all long oil and then the price starts to come down, they try to get out. There's lack of liquidity there to buy those positions off them, and you get big volatility. And the same is true in all markets now. Richard.
So a few charts on the Nasdaq. So more than 50% of stocks in the S&P 500 are now trading below their 50-day moving average. And the market is basically being supported by some of the FANGs. And for example, Apple is up over 40% on the year, has a market cap of 2.7 trillion, trading on a PE ratio of 28.7. But its forecast earnings growth is just 0.8% per annum over the next 3 years. So it is priced for perfection, as the expression goes.
Yeah. I mean, the thing is, it's priced as a growth stock, but it's gone ex-growth.
And without the 5 biggest stocks, the Nasdaq would be very negative year to date. And the orange line is the putative no biggest stocks Nasdaq graph. The difference is substantial. It's a 30% difference between the absolute level of the Nasdaq, which just shows a dependence on these few stocks. So this is a chart that was in the Financial Times today, and it shows the percentage loss from these particular stocks' peaks in 2021 to where they closed in 2000 on the 7th of December. And it's quite shocking, really. You look at some of these big names like Robinhood, down nearly 70%.
Wow.
CRISPR Therapeutics, 60%, and Editas, another sort of gene editing company I noticed is in there. I can't see it now, but that's down a large amount. DocuSign, which we spoke about last week, and I think we talked about a little bit further on, is down 50%. This is a very nasty looking graph for those companies.
Well, so this is the ARK fund, Richard, that all 44 of their holdings in the ARK Technology Fund I read were down. Not good.
No.
So valuations are very high despite the sell-off. And so over the course of the last year, you have seen a peak in the number of IPOs, the highest number of IPOs since the tech bubble, because obviously people with a company they wish to sell at an overvalued price to investors are trying to offload it to them before this little bubble ends.
And there's a graph of what's actually happening to ARK, the ARK ETF. It's not looking healthy, is it? this is a chart that shows tech versus the S&P 500, and it peaks at various points. So it peaked in December 69. Then I'm not quite sure what the significance of that was. But then March 2000, which obviously was the internet peak, followed by the crash. And now we're August 20, we're around the peak. And clearly the question is, at what point is it going to revert to, well, I'll do two questions actually. One is, what is the mean? Because obviously technology has become more important as an element of the S&P over time. And it looks to me as if the mean is probably around about, at the moment, around about 0.8%, just looking at it by eye, which suggests that tech is like 100%, needs to undergo a 50% decline in order to revert to the mean.
The big sell-off in tech was caused by DocuSign missing its earnings guidance. And so this is the share price of DocuSign. And you see that is essentially halved over the course of a couple of months, with a big sell-off last week. But DocuSign remains on a price-to-sale ratio of 14.7 even after the sell-off. And the disappointment was Q3 earnings. And what spooked the market was that it said its predicted Q4 revenues would only be between 557 million to 563. And that's only a 3% rise on Q3. So it looks like it is going ex growth as the extraordinary COVID surge in essentially home working, etc., comes to an end.
The way I like to look at this, Keith, sorry, if I just pop back to that other chart. So it remains on a price to sales ratio of 14.7, and we seem to have moved to this norm of, never mind the price earnings, what's the price to sell, but actually it's price earnings that tells you what the economic value of a business is. So if a business can, on a sustainable basis, and ultimately all companies have to move to some sort of level of sustainability, they can't grow forever, produces earnings of 10% of its turnover, then the prospective price earnings ratio of DocuSign is 147. Well, does that make any sense whatsoever, ever? And I'm reminded of Jim Slater. He had a rule, this was many years ago, he had this rule that the price earnings growth ratio, so basically if a company was growing at 30% per annum, its price earnings ratio should be 30. So on that, which I thought, which was a very sensible rule really, because it valued it on the basis of the business growth. So on that basis, DocuSign should be on a PE of 42 if it can sustain a 42% year-on-year growth. So it's 3 times overvalued on that. But if it can only drop down to 20% year-on-year, it should be on a price earnings of 20. Now, do the sums, you find that it's even now, it's 7 times overvalued.
Absolutely. Well, the reason you can't value it on a P ratio, Richard, is because it's losing money still.
Yeah, you just have to guess what its PE ratio might be.
Yeah. But on the fact that its price to sales ratio is 14.7, and actually I calculated this a couple of days ago and its share price has gone up since then. We covered this a little while ago, but a reminder, this is a quote from Scott McNealy, of the CEO of Sun Microsystems, who said this in the aftermath of .com. Now, I'm not going to read it out again because I've read it out before, but basically, Sun Microsystems was then on a price to sales ratio of 10. And Scott McNealy, looking back, just tells investors what idiots they were buying his shares at a price to sales ratio of 10. If you haven't heard this quote before, I suggest you pause the video and read it. But, if you're thinking of buying DocuSign at a price to sales ratio of 14.7, have a read.
Or ARC.
Yeah, absolutely. And, this is what happened to the share price of Sun Microsystems after .com. It went from 65 to what? 5. So, When these growth companies go ex-growth and optimism changes to pessimism, there is no bottom, or the bottom is a long, long way down. Okay, moving on. Now, one of the things that I have got completely wrong this year is bond yields. And the Fed has obviously failed to raise rates. And what has been really puzzling is the fact that bond yields have not responded to inflation. But we have, implicit in my kind of worldview, is the assumption that the Fed has some control over bond yields, particularly at the short end. But Robert Armstrong in the FT had a series of great charts which suggested that the bond market was doing its own thing entirely. And so this is a chart of the US 30-year yield compared to the Fed funds rate. So the blue line is the 30-year yield, and the red line is the Fed fund rate. And you'll see there's no relationship between the two at all. The bond market is doing its own thing. And if we look at the 10-year rate, you'll see perhaps there is a bit more sensitivity, but really not much. And the blue line is US 30-year mortgages. Now, they tend to follow the 10-year because they can be refinanced at any stage. So they actually have a much shorter actual maturity than 30 years. And they tend to follow the 10-year. And you see there is some sort of relationship, but really not much. And actually, when you look at the 2-year, you could make the case that the causality is the other way around, that actually the Fed funds rate follows the 2-year rate rather than vice versa. So this is what happened in 2018. And you'll see the 2 and 10-year came down even while the Fed fund rate was still rising. And then the Fed fund rate follows the bond market with a lag. So this piece was basically making the case that the bond markets are entirely separate from the Fed funds rate, and that actually it is not the very low Fed funds rate and the actions of the Fed which is causing the extraordinarily low bond yields we're seeing. So something's going on that I continue not to understand.
That's an interesting point, Keith, because we also work on the assumption that interest rates will move if the Fed increases its base rate, that the longer term rates will go up. But what those graphs are suggesting is the Fed may increase its base rate up to a level which coincides with the top end of that downward sloping channel, but of the longer term rates, but the longer term rates will continue in the channel, and then at some point the Fed funds rate will drop back out of it. That is what's happened over the last 30 years.
Yeah, is that essentially the bond markets are completely doing their own thing and ignoring inflation. That's what I find absolutely mystifying.
So China. So China's credit growth has been enormous, and there's no country that's had similar credit growth without having a financial crisis. But of course, there's no country that's had similar credit growth to China. So I noticed that we have official default by one of the credit rating agencies on Evergrande today. And whether the Evergrande is contained or not remains to be seen. But it is now recognized by credit rating agencies that, and this one is another Sunshine 100 China Holdings Limited, another Chinese developer. And then there's another Chinese developer, Telsa, which I think is also defaulting on its bonds. So the issue seems to be gathering a bit of momentum. and the Evergrande bond price has dropped from 100 to 24 in 6 months, which sort of belies the concept in this case that bond investors are very smart people.
I know that's a misfire. I remember when the Evergrande international bonds, they were trying to raise $10 billion. I just thought you have to be a total idiot to buy these things. But, bond investors are smart.
So Oxford Economics is forecasting that a possible slowdown in the Chinese economy may occur due to the fall in the housing market. I think that's a fairly sensible, forecast. It's inevitable, surely, that I think there will be a slowdown in the Chinese economy due to the fall in the housing market. How big it is difficult to tell, and also how much they could substitute other activity for loss of housing activity remains to be seen.
You'll notice, Richard, that though even in a severe downturn, they're not forecasting recession.
No, they're not. And also forecasting a rapid rise back up.
Yeah. Okay, so moving on, some real-time US economic indicators. So with the resurgence of COVID, of the Omicron variant, how is the US economy doing? We have some live data. So the red line is airport travel, and you'll see that you're well up on last year, but down on 2019. In the last few days, you have had a drop-off, but is that seasonal? You had the same drop-off in 2019. So not any real evidence of disruptions caused by Omicron. Dining, actually pretty reassuring. Last few weeks, you have had a drop-off in, where's that, Texas. But generally, things have recovered, although you'll notice in some places like New York, you're still 30% down on pre-COVID. Cinema attendance is well up on last year, and we are now coming into the big Christmas cinema visiting period. We'll see, but there's no evidence of a drop-off recently. Hotel occupancy actually is really good. We're now pretty much back to the median, and no evidence of a fall recently. Gasoline usage is back to normal. Apple Maps data suggests people are moving around, and actually post-Thanksgiving, pretty good. So no real evidence that Omicron is causing economic disruption yet in the US. I mean, this is Subway data, and it basically just shows that, working people are now working from home and not going in so much. And you'll be aware that the UK have put in new restrictions to try and contain Omicron and have told people to work from home where possible. And on that note, the effect of new COVID restrictions on the UK economy. And bottom line, there aren't any really, not yet. So this is data from the FT this morning, and it shows that actually in the last few days, we've had very strong payments data as people go Christmas shopping, that consumer spending, I don't know quite what this dip was caused, but year on year, we've had good growth. And if you look at the successive impacts of the COVID waves, you see the first wave, you had severe recession, second wave, mild downturn, third wave had little impact. And there was a range of opinion in the FT this morning about the possible impact of further restrictions, but economists were saying, honestly, it probably wouldn't have very much. It's reduced GDP by about 0.2%, though that didn't stop the Federation of British Employers asking the government for some subsidies and predicting a 2% knock to GDP.
I have some sympathy with that point of view, Keith. It remains to be seen whether they're right, but I think that Christmas is such a big time for entertainment and venues, and I think it sort of it generates a large chunk of their annual profitability, and so it doesn't take very much of an impact on the Christmas and New Year celebrations to dent their profitability substantially. I think that's their concern. I mean, one's minded Woolworths made all of its profit in 2 weeks of the year before going bust for obvious reasons. And but it is a difficulty with these highly seasonal economic activities.
Yes, good point. And finally, on to other charts. Richard.
World GDP is being revised higher. So JP Morgan are suggesting that global GDP is ticking up very nicely in the fourth quarter. And next year, the US will have to restart bond sales because it's drawn down all the funds from the Treasury General account that Donald Trump built up. And we shall see what demand then is for bond sales when that happens, whether the Fed tapering is going to impact the price at which bonds can be sold.
Yes, so this will withdraw liquidity from banks and the markets, as opposed to the last couple of years, the Fed has been injecting money into the markets.
So in the last 2 quarters, US business has posted its widest profit margin since 1950, which is sort of extraordinary, really. You wouldn't have projected it in perhaps April 2020. And one of the questions is this going to be corrected by a increase in wages and input prices? It also suggests actually that businesses are able to take a bit of a pricing hit or a cost input hit and not pass it on to consumers.
Well, one thing we've covered in previous weeks is how profit margins are very high, as shown in this chart, but also the market's expecting them to keep on rising. But what this chart shows is they're strongly mean reverting. Yes. So watch this space.
Yeah. Goldman Sachs has slightly reduced their US GDP forecast for 2022, but it is a very slight reduction. And really, it's all a bit of a guess at the moment because we don't really know how dangerous Omicron is going to be in terms of hospitalization, serious illness.
Yeah, but they're still forecasting plus 3.8%, which is good.
Yeah. And the ISM services report was a record high, which suggests one of the concerns was we had stagflation. Well, we've certainly got deflation, but we do not appear to have the stag part of it, which is good. Capital goods, investment, manufacturing, new orders are looking very strong, which actually means that manufacturers are feeling quite, well, one, they're feeling quite optimistic, and two, we don't really know what the effect of deglobalization is on this investment, but you have to think that deglobalization would increase capital investment, and maybe we're seeing a bit of that as well.
Well, this is interesting. So this is a chart which Paul Krugman posted on his Twitter feed, and it shows Americans' assessments of their own financial situation. So the data is patchy, but what it shows is they're feeling very good, actually, recently. And funnily enough, they were feeling pretty good even before the pandemic. Yeah. They're feeling the most positive they have been since the Reagan era in the early 80s. Passenger
electric vehicle sales as a percentage of total sales quarterly. So Europe, Middle East and Africa are doing best. America is doing actually very poorly. As noted at the side, the impact on global gasoline demand is very limited at the moment.
These are not big numbers, actually. 18% of vehicles in Europe.
Yeah, it's a lot. We will run into some sort of electrical grid problem at some point.
Yes. Well, we've seen the price of power. This isn't going to help the situation.
No, it's not, is it? So moving on to COVID, looking at South Africa, the Omicron spike is very apparent and it's very steep in terms of the cases per million. The reproduction rate is interesting. The reproduction rate, the R0, is very high, and I think the UK case numbers are repeatedly doubling every 3 days, which I don't know what the imputed R0 on that is, but it's higher than the Delta variant. So this is good news. And what it's saying is that although hospitalizations lag infection by several weeks, it is suggesting that the Omicron wave is not causing a significant increase in the number of COVID patients in hospital.
Actually, Richard, it's saying that a lower proportion of people with the Omicron are going to hospital, but
there's more of them who have it.
Yeah, that's right. And as a result, hospitalizations are rising. Yeah, that's the concern. Although it is less dangerous, that people are getting it much faster. There are more cases.
The Omicron wave is it's ominous, isn't it? In its speed of rise.
Yeah, but I mean, this is all perfectly compatible with the usual path that diseases take of becoming more virulent, but less deadly. So it's on its way to become just seasonal flu or seasonal cold.
Possibly. I think it's a little bit early to make that conclusion, Keith, because the argument there is that if it's too dangerous, if it causes too many fatalities, it doesn't get the opportunity to spread. But actually, if you look at the proportion of the population who die from it, it's very, very low, partially because of medical intervention, but that's sort of irrelevant. So the evolutionary pressure not to kill the host is not that great. So I actually don't really buy the argument that it's just going to settle down to a mild sort of flu-type infection. It may do, but I don't buy the argument that it's just going to follow this course because.
Yeah, no, that's a very good point, Richard, actually. And if we go to this table at the end here, you're right. I mean, it's an extraordinarily mild disease, actually, particularly if you're young. Under 20s, their survival rate is 99.997%.
Yeah, it's very. The problem is this societal problem of older, in the main, older and more vulnerable people can get very, very ill with it, and that overwhelms the health system.
Okay, on to the checklist. So it was generally a strong week for markets. All share up 2.1%, stocks Europe up 1.5%, S&P up 2%. Nasdaq is lagging now, up only 0.9%. Topics in Japan up 0.9%. Bitcoin had a bad week, down 15%, although it remains up 65% year to date. And Richard will go through Bitcoin in a minute. Sterling continues to drift off, down 0.4%, down 3% on the year, and the dollar index was flat. Now, what was interesting is that, as we've discussed previously, consumers have a lot of money in their bank accounts and they want to put that to work and they are buying the dips. So there was record retail buying on the recent stock market dip.
This is the Ether chart, but in terms of Bitcoin, I think that there are a couple of things that are spooking the market. One is the Fed taper, and it has the rise in Bitcoin being caused in part by the huge amount of QE that governments have done. And with that coming to an end, is it bringing is it going to bring the price of Bitcoin crashing down? And the other one is there's been quite a lot of sort of not particularly encouraging regulatory announcements. India has announced that it's not comfortable with having cryptocurrencies. Obviously, we had the move back by China a couple of months ago. I think the SEC is concerned with crypto markets generally. So there's quite a lot of regulatory headwind as well. So this little chart just shows that Ether basically is in has been in a range for the last month or so, a pretty volatile range, it has to be said. And I've done a log chart of Ether, which shows it is actually since the beginning of 2020, early 2020, it is still following the logarithmic trend. So if it maintains itself above that line, then obviously the price needs to start moving a little bit higher fairly soon. And the Bitcoin chart is basically it's gone nowhere now for a year, and it's gone nowhere. There was a lot of volatility, a big gap down last weekend, I think that occurred, and clearly the market is uncomfortable. And I put in the shit perp chart. We haven't looked at that for a while, and actually, perp hasn't done. Given what's happened with Bitcoin, shit perp hasn't actually done too badly, I would suggest. I haven't looked at it. I haven't looked at it for several months, and I thought it's bound to look horrible, but it doesn't look great. But it doesn't look horrible either.
Okay, on to commodity markets and energy commodities. Well, oil bounced back, up 4.3% on the week. Dutch natural gas futures continue strong, up 6.5% on the week. And they had a strong week, partly on the back of fears of Russia invading Ukraine, and then the Germans not certifying Nord Stream 2, and so reduced gas flows from Russia. And you've seen earlier, we talked about electricity prices in Europe being very elevated. We have an energy crisis in Europe. Coal was up 4% on the week, bouncing back from its recent weakness, and it's now up 100% on the year. Uranium continued to slide off, down 1.1% on the week. So this is crude, and well down from its highs, had a bit of a bounce back, and then renewed fears over Omicron have caused it to dip in the last couple of days. Basically, it is following the headlines up and down. Now, Russia is a member of OPEC Plus, and we are concerned about whether OPEC Plus have the spare capacity that they claim. And this is crucial in understanding the future path of oil prices. If OPEC Plus do not have the spare capacity they claim, then the market is much tighter than anticipated. And next year, we will not see the surpluses that OPEC are forecasting. Now, so this month, we had data for Russian crude exports in November, and you'll see they only rose by 33,000 barrels a day when they were permitted to increase by 100,000. And that suggests that Russia are actually hitting supply constraints. Regular viewers will know that we've covered the seasonality chart for oil, and it is generally poor going into year end. And you're tending to see storage builds, and that is what you are seeing in the US. Storage is building into this time of year, and it is perfectly normal, seasonal. Okay, so this is the Dutch natural gas future, and that is not a reassuring chart. We've had a huge spike in October, and it's come off, but now it's drifting back up again as we are not solving this energy crisis. So that's the TTF chart is top left. You'll see bottom left that European gas storage is well below its normal levels and falling quickly because we have so far had a cold winter in Europe. And as a result, power prices in Germany are going through the roof, as we've covered, and carbon prices are not helping. Coal is ticking up a bit, and reminder, China is burning more and more coal. No matter what we do in the West to try and reduce emissions, China is burning immense quantities of coal. and uranium is coming off a bit. Richard.
Thanks, Keith. So running through these, aluminium almost unchanged on the week. Cobalt continuing its uptrend. Copper very slightly up on the week. Chromium down 2.7%, but iron ore up 4.5%. Lithium continuing to rise inexorably, 5% up on the week. Magnesium, last week I believe it was significantly down, but it's perked right back up this week. Neodymium continuing to rise gently. Nickel slightly down on the week. Tin continuing its rise. Ferrovanadium unchanged. So not a quiet week on the commodities, but quite significant movements in amongst them. There's aluminium settled down at that 2600 level. Cobalt continuing to climb. Copper hasn't moved really for 6 months now. And I think my view is it will start to, at some point in 2022, it'll start to climb again.
We know inventory levels at the major commodity exchanges are extraordinarily low.
Yeah. Chromium has basically gone nowhere for 10 years and is moving within its very large range. Iron ore, it's going to be kicking around a bit, isn't it, if they do say what it's doing at the moment?
Well, it's bounced back in the last couple of weeks, but so much depends on the outlook for the Chinese property sector.
Yeah, that's right. Lithium just continuing to rise. Battery demand continuing to rise with it. So magnesium actually is showing, having spiked and fallen down, is actually showing quite a significant uptrend. It's up 30% in the last five or 6 weeks. Yeah. Clearly something is driving that. The neodymium looks a strong chart. It's nearly quadrupled in a year and a half. But nickel is continuing its upward trend, as is tin. And ferrovanadium is quite steady at around about 32 kilograms.
Yeah, there's high correlation between ferrovanadium and iron, I'd say.
Yeah, I think that's right.
You're moving on to precious metals. So gold was up 0.5% on the week. Silver continued to fall, down 2%. Platinum and rhodium were flat. Palladium down a touch, and they were all disappointing. Given that we had a resurgence in inflation this year, precious metals have not been a hedge.
No.
The gold chart going nowhere. Silver towards its lows for the year. Platinum towards its lows for the year. Rhodium flat. Palladium towards the lows for the year. So the PGMs are really awaiting the recovery of global auto manufacturers, and when they get going again, they will need more catalysts.
Yeah. Finally,
on to rates, and mystifying yet again. So in the UK, we had fall in yields across the curve, despite elevated inflation. A reminder that UK CPI is 4.2%, UK RPI is 6%, but the yield on the UK 30-year is 0.86%. And so the markets have had a flight to safety over Omicron. But as Richard mentioned earlier, in the Eurozone periphery, bonds are drifting up. So the Greek 10-year yield rose quite a lot during the week, up to 1.36% from 1.2% last week. And the Italian 10-year also rose. So if we look at the charts, this is the Greek 10, and that is the high for year. This is the Italian, which is slightly better. UK, amazing. Right back down. and US 10-year, not following inflation higher. And we're going to skip the seasonality chart because Omicron is mucking it up. Richard, what have you been up to this week?
Thank you, Keith. So I had a not particularly good week, down 0.9%, up 8.1% a year, a long way behind the FTSE All Share. And this time last year, I was doing very well with the cryptocurrencies. And I think gold miners had done very well in the late summer and early autumn. And I've been keeping my fingers crossed to say what happened this year. Time is running out, sadly. So I have been sitting on my hands, very inactive, no purchases, no sales, nothing went on. I did notice this, though, which is the cull fails to halt the largest ever bird flu outbreak. This is in the UK. And this is unfortunate because it has a huge impact on UK farming. And it just shows how dangerous these viruses can be and how vulnerable we are to these mutations that come by, not just human population, but agriculture as well. So just a short one from me this week, Keith. How about you?
Thank you, Richard. Well, I had a slightly disappointing week as well. I was up 0.9%, which was less than the all share, takes me to 7% year to date, and lagging the all share as well, lagging Richard and probably Stuart, despite taking a lot more risk. Now,
not that we're competing.
Well, I think we are actually, aren't we? You're just not aware of that, Richard, but I definitely am. And failing. Anyway, so I had one sale this week. I sold Touchstone Exploration, and for a small profit. I'll show you the chart in a sec. And I used the money to buy Sylvania Platinum, which I had sold previously. The ticker is SLP, and we did a share talk on Sylvania Platinum. And if you're interested, take a look. It's the shares are good value. And now that the automakers should be reopening as the global chip shortage starts to ease, I expect that PGM demand will start rising again and Sylvania should recover. There's Touchstone Exploration. Bottom line is that I was waiting for the results from the Royston well, and the Royston well, I mean, they found hydrocarbons, but the water cut was really high. And this is a long-term chart, and you see it's had a very good run up. And, disappointing drilling results. I am concerned that there's a lot of good news already in the price. And so I opted to get out at 104 because I have previously been in oil companies where there has been a great deal of expectations, and disappointing drilling results can result in the share price going right back down to where they started, and they started at 15p. So potential for a long fall, but Touchstone have good assets and more drilling results coming out. So if there's a turnaround in its fortunes, I may well get back in. But I instead opted to put my money back into Sylvania Platinum, having sold out around here. So hoping for a turnaround in its recent fortunes as car makers start working again. And that is it. So it's been a long one this week. Thank you to everyone for sticking through it to the end. Please can you press like and subscribe to the channel. Merry Christmas. And in the meantime, it is goodbye from Richard.
And it's goodbye from Keith.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.